Everybody, Marty Mazur. Good evening. The 8th of December, 2016. Want to do my usual video with you. You're looking at the one-year daily chart of the S&P 500. I've been bringing your attention to this line that connects the February low to the Brexit low. And you can see it was a definite trend line, and the market found resistance against it, then a little bit of support, and then once again has come barreling above it. We'll see how we do. Yesterday's move was really more about more accommodation from the European Central Bank. Very bullish for our market. Good for global markets, in fact, at a time when the U.S. Central Bank is about to continue what would be viewed a tightening policy simply by nature of the fact that it'll be raising interest rates going forward. I think that's a pretty safe bet. These two lines, the 50-day and the 200-day moving average, are still looking very good. They're pointing in the right direction. This one on top of that one is a good sign. Good things tend to happen as long as that's the case. So, folks, there's no question, though, that the market doesn't go up forever. Trees, as they say, don't grow to the sky. So you look at other technical indicators. I've shown you these before just to look at momentum. By the way, this is the AD line showing very good breadth. That's the advanced decline line. But this is the moving average convergence divergence. I call it a momentum oscillator. It looked like it was going to give a negative short-term signal, and then we had that big bounce yesterday. The slope, however, is not real encouraging. This would suggest that maybe this rally is losing a little steam, although it's not a strong bearish divergence by any stretch of the imagination. But you want the MACD to continue to move and slope like the market. There have been some pretty good signals historically that suggest the market has got issues when this diverts from, for example, peak to peak or trough to trough from the direction of the trend. The relative strength index, which a lot of technicians and swing traders, short-term traders look at, to determine whether stocks are overbought in the short term. Above 70 is considered an overbought range. So you can see we're in that territory. Often the market will trade off a while when it gets to there. But to go from overbought back into more reasonable levels from a momentum and from a strength standpoint, it doesn't mean you have to come down. It could mean that you move sideways. So there's a lot going on. It's a very dynamic market. As you probably know, we're entering into a period that is pretty good historically from a seasonality standpoint, and some people will trade on that. And that's the last 2 weeks of December. So I want to keep it quick today, but just bring you up to date on sectors. I've been showing you from time to time different sectors using the exchange traded index funds for each, and showing a chart that shows the relative return relative to the S&P 500. And as this began to break down, I was telling you that was actually a signal that maybe the economy is about to heat up. In this case, it's healthcare, which is a pretty defensive sector. So you can see that since September-ish, healthcare really began to underperform the S&P. That's what that signifies. Very much so for utilities. We have a zero target to utilities, very interest rate sensitive. You can certainly see since the election, utilities have really given up the ghost, and they've been a very good place to be for quite some time. But they're not going to be a place to be if the economy, at least historically speaking, if the economy is indeed going to accelerate into the later stages. Same thing for consumer staples. They've been a good place to be for a few years, relatively speaking. They've really given up the ghost. And what you're seeing here, folks, is rotation out of defensive sectors into more cyclical sectors like industrials. You can see industrials have had a very good move relative to the broader market, certainly since the election. Same can be said for commodities in general, the global commodities index. This would be commodity producers, both U.S. and non-U.S. Energy has had a really big bounce late November up until currently. A lot going on with OPEC and so on. Materials, very nice bounce. They actually started bouncing earlier in October. You may recall back then before the election, I was talking about the relative strength in things like materials and industrials and how that maybe was signaling a better economy going forward. Consumer cyclicals, big bounce off of the November move or the November election. And then financials, huge bounce. Our largest weighting is to financials, or our largest target, I should say. They have been pretty much the bottom of the barrel for quite some time in an environment of higher interest rates and certainly of deregulation. It makes sense that financials have had the run, and maybe there's some room to run to the upside, although I do expect pullbacks, folks. It's just part of the territory. And then lastly, technology. Technology has taken a really rough hit from the election, and I think this really speaks to more the multinational character of the big technology companies. Many of them, better than half of their revenue comes from abroad. Of course, we know there's the anti-trade rhetoric that's going on, but notice just recently, um, technology has been mounting a bit of a comeback. Certainly, it would be a cyclically sensitive sector that ought to do well in an environment of a faster growing economy. Another area that, as you all know, longtime listeners and longtime clients, that I am very much in favor of is investing in non-US stocks, where most of the world's population and many of the world's opportunities lie. We certainly virtually have to avail ourselves of those opportunities. We're in a well-diversified portfolio. But since the election and even leading into it, you can see a huge underperformance. This is emerging markets. This is developed Europe, Australia, and the Far East. But this chart I cut off on November 15th. If I run it all the way to year to date, notice we've begun to turn the corner a little bit. So the last few days, 2-3 weeks, actually the non-US portion of our portfolios has actually been performing, at least the outperforming, I should say, the S&P 500 index. So we'll see how that looks going forward. The European stocks, from a valuation standpoint, when compared to the U.S., haven't been this low, again, on a relative basis since 2009. That's a scenario I like. Going forward, there's been quite a distance here of underperformance, so we're looking for that perhaps to do better going forward. I know there are issues there, which is one of the reasons why the valuations are there. So I'm sure more on that on a later date. Look for my weekend commentary in the next day or two. And thank you as always for watching and listening, and I'll talk to you again very soon. Bye-bye.